Well, yes, as you say, the Bank of England has raised interest rates for the ninth time in a row. It's worth saying that the Federal Reserve and the ECB, the European Central Bank, have made similar moves in the past 24 hours. But focusing purely on the UK, if you take a look at this graph over here, you'll see that we've all been used to more or less a decade of very low interest rates. But from the end of last year, you can see that that changes and changes sharply. So today, we find ourselves at 3.5%, a figure that was last seen during the financial crisis in 2008. And it's one that will have an impact on people's ability to borrow and the prices that lenders charge. Now, all of this is part of the Bank of England's strategy to get inflation down. It hit a 41-year high in October. It's now at 10.7%. They want to get it down to their target of 2%. So we're obviously a good way off that. But the good news today is that the bank thinks that it's peaked, that it will start to taper down, although over the next few months they say it would still remain very high. And the other bit of, I suppose, caveated good news is that although the bank says a recession is still on the way, now that's when there's negative growth for 2 consecutive quarters, they say it won't be as bad as they expected, with the economy shrinking by 0.1% instead of 0.3%. So I suppose the overall picture is still pretty bleak, but not as bleak as expected.
And our rate's still expected to keep going up?
Yes, well, the bank's Monetary Policy Committee, who set that rate, increased it more slowly this time than they did last month. So lots of financial analysts think that the peak next year will actually be lower. It was supposed to be around 5.25%. They're now thinking it'll be more sort of 4 to 4.5%. But there are still a lot of challenges in the economy. Lots of people saying this interest rate rise will hit families who are already struggling with the cost of living crisis. But the government and the bank say it's the only way to bring inflation down.
We have high inflation. It has a corrosive effect across the economy, to wages, to the growth imperative for people across businesses. We've got to get inflation down, and I welcome all action that the bank takes to do so.
And so how is this feeding into mortgage rates?
Well, mortgage lenders were expecting this to happen, so it was already baked into the pricing for their new fixed-rate mortgage products. Many advisors have told me that they're stabilising, they're on a downward trajectory. That's not to say, though, that they're not still high, but they are falling from that peak we saw when the gilt market started wobbling in the wake of the mini-budget. So on an average 2-year fixed-rate mortgage, which back then peaked at 6.65%, that's now 5.83%, and for an average 5-year fixed rate, which peaked at 6.51%, that's now at 5.63%. But if you're on a variable or a tracker mortgage, which correlates to the Bank of England interest rates, so that affects around 2.2 million people, you will be seeing your bills go up by around £49 a month, according to the Trade Association UK Finance. That's certainly a worry for lots of people. It's good news if you are a saver. Interest rates going up is a good thing for you.
Amelia Jen, thank you.